Absolute pleasure to be here this morning. Speaking of infrastructure spending, did someone mention that? It took me over an hour to get from the airport. I thought I had plenty of time, but anyway, I might come back to that. 15 minutes is not long to talk about the economy at the moment, so this is going to be pretty high level. If you haven't read this, it is a good read. I did remind myself when preparing this short prezzo kind of what I wrote in here, and it's not that positive. Now, I will go through aspects of that. So, global backdrop's improved. That's quite positive. But then you go through it. Investment-led recovery is required. Well, yesterday's numbers weren't good on that. China's tricky path. Can markets cope with US rate hikes? Australia's challenging period ahead. Growth to remain subdued. Key risk is even lower commodity prices. Consumer spending is not going to be the driver of growth. Lower currency will help, but it's no panacea. Plenty of spare labour market capacity, no inflation, scope for the RBA to lower the cash rate further. So it's riveting stuff, and the key message from that is it is going to be a challenging period for Australia over the next few years. It already is quite challenging. But firstly, I should also say we've been doing this with CEDA for the last, 3 years, and it's been a good relationship so far, so thanks very much, and hopefully we can do it in the future. So, in part, it's a little bit depressing at times, thinking about the economic outlook at the moment and what's happening in the economy. Things are okay, but they're not flash. But I don't want to dwell too much on that stuff, and I will finish on some of the positives that people need to think about or can focus on for the next couple of years, because it's very easy to get caught up in the negatives. I could spend a lot of time, talking about falling commodity prices and the terms of trade, which is weighing on our national income, government revenue, real wages, and the labour market. This is a pervasive adverse effect on the economy that we're now going through. The terms of trade boom had a big positive impact on the economy, and we're now seeing the reverse of that. I could also emphasise that the exchange rate is still overvalued based on fundamentals, and noticeably overvalued still in our view, and that means even though it's come down, that is still a headwind for some parts of the economy. I could also talk for probably an hour or maybe a day on the tricky path ahead for China. China grew at 10% per annum for 30 years. Its 3 years before the crisis were much, much stronger than that, which saw extreme strength in commodity prices, which helped us along. But the crisis came along, they threw a lot of credit at their economy. When that happens, you never know what's going to come out the other end as credit growth and growth in an economy slows up. That's the challenge they now face. We don't really know how that's going to play out. So far, so good, but it's clearly having at least modest adverse impacts on the prices of bulk commodities that we export, particularly to China. You'd probably be aware that we have a little bit of a confidence problem in our economy as well. It's not a huge problem, but it's just that confidence has been a bit below average for an unusually long period of time now. That's what happens when you have financial crises. They cast long shadows over growth for up to a decade, and we're still firmly in that period, both in Australia and globally. So measures of consumer confidence are below average, and business confidence are at or a bit below average. The key point, though, is they're not where they were pre-crisis. That was the unusually strong period of growth in our economy, which we're not going back to. It's now also widely known, and I won't spend much time on this, that the massive spending we had on resources investment, largely iron ore, coal, and most of it at the moment is in the gas or LNG sector, that's now in reverse, and it's got a long way to fall. That'll have implications both as a drag on growth and also for the labour market. What might be less understood, though, and we put out a major report on this a couple of days ago, is that the increase in infrastructure investment, public-backed infrastructure investment in Australia, or the mooted increase, is actually pretty modest over the next 2 to 3 years, and particularly outside of New South Wales, where it is starting to pick up. So the offset from that as mining investment comes off is very modest indeed in the next couple of years. And with the long lead times on projects, there's not much you can do about that at the moment in terms of bringing stuff forward. And the bright spot of the economy in terms of strength, which is clearly the housing market, because interest rates are low and population growth is strong. Even there, if you look hard enough, you can find some worrying signs that investor activity there is very strong, particularly in Sydney and to a lesser extent Melbourne. I'm talking about domestic investors here, not foreign investors. That's another interesting aside. So the share of finance, housing finance going to investors is at an all-time high at the moment. Now our regulators are well on top of this, of course, but it's something that if it were to persist for a long period of time, you can get this negative kind of loop happening with house prices. So we don't want to see that. So putting all that together, if you look at our GDP growth, and this is over a long period of time, you can see that on average, since the GFC, we've been below long-run average growth, which is about 3.5% in the economy, or the average rate of growth we've seen over the past 10 to 15 years. So I could spend a lot of time on that, but I think you get the point. The other one is that that's going to persist. So for the next few years, this transition away from mining investment to other sources of growth, which is happening, it's not happening fast enough. The non-mining parts of the economy need to grow at above average rates for a few years. And at best, it's approaching average rates at the moment. So we're sitting below 3% growth. The composition of that is less labour market friendly in terms of generating jobs, so the unemployment rate's going to keep trending slowly higher in our view and in the view of most other economists. That's all pretty pessimistic stuff. I want to try to look for a couple of slightly more positive things that are happening, particularly for if you're in business to focus on. The global backdrop is getting better. The global economy is growing. It kind of always grows. At the moment, it's only growing a little bit slower than its long-run average growth rate of about 3.5%. Again, the problem is it's not growing at those super strong rates of growth that people got used to pre-GFC. But that's now 7 years ago, so hopefully people's memories of that have faded. But clearly here you can see unemployment rates in the major developed economies are heading lower. The outlook for Europe, if anything's got a bit better over the last couple of months in terms of cyclical recovery and growth. We're not talking about super strong growth, but better growth. But the US is where the real positive story is globally, and that's important for Australia. We still have strong ties to the US economy through confidence, financial market channels, and investment linkages. So the lower oil prices as well, clearly, if there's any mistake here, it's unambiguously positive for Australia, the US and the global economy. It's not unambiguously positive for Russia, but that's their problem. So for us though, it is, at least over the next couple of years, lower oil prices are, it's a positive supply shock, and that's positive for Australia and the US. So why is that important? Well, one aspect of this is that our investment cycles in Australia and the US, as I touched on, are somewhat correlated over time. So this shows investment intentions from business surveys in the US and Australia, and you can see that clearly they're correlated over a long period of time. The problem here is that investment intentions have picked up a bit, but they're still a bit subdued. Some indicators are a little bit worse than a bit subdued, but I won't go into that. But in the US, things have picked up quite strongly. Their growth is actually a bit above trend at the moment, and we see that persisting for some time. So when people talk about rates in the US, interest rates, that is going up around the middle of this year, from 0, of course, that's a positive sign. Another aspect of that is that we think that'll strengthen the US dollar further. It's already strengthened quite a lot. And the flip side of that is a weaker Aussie dollar, and that'll help the transition in our economy. But we actually have had some improvement in our economy. If you look at growth or domestic spending growth, excluding this drag from mining investment, which is happening, there's nothing we can do about that. The other parts of growth actually have picked up, and that's the orange line on this chart. It was just that it was a lot weaker 18 months ago, a lot weaker. So things have got better, And the business surveys which are correlated with this have got a lot better over that time as well. But they're still, as I said, only around average rates. They need to be above average to offset this drag from mining investment. So that's good news for some parts of the economy. Many businesses are doing better, just none are really super strong at the moment. Get used to it. The housing sector clearly, and businesses tied to housing, we think have got a positive outlook for the next couple of years. We think with interest rates likely to stay low for an unusually long period of time, the level of construction activity should stay unusually high, particularly in New South Wales, for a long period of time. That will have positive flow-on effects to businesses keyed into that sector. Another aspect of that is population growth. Now, over short periods of time, strong population growth can be a good thing. It greases the wheels for businesses. In the long run, it kind of doesn't matter on a per capita basis. That's a different debate. But population growth nationwide and in Victoria is quite strong at the moment, even though it's just slowed up a touch. It's running at above 1.5% per annum. The lower Aussie dollar, even though our view is, and it's clear that it's still overvalued because it's chasing commodity prices lower, the benefits to other parts of the economy are starting to be seen. And one place you can see that is in the tourism sector and education sectors as well. They're big export, recipients of export dollars. They have been kind of in the doldrums. But clearly, as the currency has turned around, we've seen in a net sense, the money we're getting from education and tourism has turned around as well. We think that will continue, and that's a positive story. You're also seeing it anecdotally. It's very early days, but you're seeing it anecdotally in our own liaison as a commercial bank, but also in the press and elsewhere, that the lower currency is starting to make people think about buying stuff onshore rather than importing it. That's a very important way initially that the lower currency works. It's not so much through the export side initially, it's through diverting demand back to Australia. That is happening, it just needs to happen a bit quicker than what we're seeing. Our view is the currency's got further to fall, probably into the low 70s if you're just thinking about it against the US dollar. Finally, another positive, and this is very early days and a slow burn, is that the adjustment that needs to happen in our labour costs in Australia is slowly happening. If you look at our unit labour costs, which take into account productivity, we had run ahead of the rest of the world, pretty much the rest of the world, over the terms of trade boom period. As the terms of trade come off, and this is going to be a slow burn, as I said, this adjustment will happen. If you take into account the currency move, it's happening quite quickly. It's just, in a level sense, our labour costs are still quite high, but they're starting to head in the right direction. So, that will take a long time and will restore our international competitiveness, and it's a drag on spending growth in a cyclical sense, but that adjustment is happening, so you can take some positives out of that as well. I will finish on this. I'm an economist, not a political analyst. However, the thing that worries me the most in a medium-term sense is that inaction politically, or whatever you want to call it in Australia, will continue for some time until we have a serious downturn in the economy that focuses the mind. The other aspect of that is every time someone puts up a good idea, economic idea, structural reform, there's always someone that comes out these days saying that it's a bad idea because some people lose out of it. If we're going to get anywhere, we have to have some losers, unfortunately. Hopefully it's not poor people and less advantaged people that are the losers. Hopefully it's people like me that don't need to get $7,500 a year in terms of a childcare rebate. It's just craziness. I should be getting taxed more on super and things like that. These are pretty clear, easy wins, in my view, that need to be made. I'm just not sure people ready are yet, unfortunately, for those changes to be made, which is very unfortunate. Thanks.